So once again, a positive performance for the NSE. We've got a very stable Naira as well. What a way to end off the week.
Yeah, I think it's a good end to the week. Some good positive Q1 results coming out of a few banks. And so the trend seems positive for now.
Let's just touch on Treasury bill rates. They've fallen over around 200 basis points this year. What is your view on this when you compare it to a lot of the other bond yields, which have not fallen as much?
Well, I think it's interesting. I mean, we had an inverted yield curve at the beginning of the year. Some T-bill, one-year T-bills were as high as 17.5, where longer-term bonds were going at 16 point something. So clearly part of it is just a readjustment of the curve. Now you have a gentle upward slope from the 90-day going out to like the 10-year. But of course, I think it's a bit interesting to note that clearly the easy money seems to be being squeezed out of the T-bill end because T-bills have dropped over 200 basis points. Most FGM bonds have only dropped about 100 basis points this year so far. So it's either there's two things are happening. The curve is being readjusted, but also rates are trending down.
Yeah, I mean, when we look at these very high bond rates as well, I mean, other issuers, might be stuck in a predicament where they're seeing these very high yields. This obviously not being a fantastic environment for issuers, but rather for the buyers of these bonds. What do you think will happen? Do you think issuers will just wait for these yields to drop slightly, or do you think they would enter the market at these levels?
Well, I think right now, I mean, if you separate the two issues, if you look at the state governments who have been the most active in the market over the past few years, at least over the past 5 years, I don't think any state has issued a bond much higher than 15.5. I think maybe Kwara was slightly higher. But clearly, going above 15.5 is something that most states simply will not do. Ondo was at 15.5 in February. And a lot of the issuers are just simply seeing these federal government rates and just deciding to wait out for a slight reduction to the point where it might be interesting for them to issue.
Yeah. Okay.
But at these levels, it's still expensive.
Okay, still expensive. All right, I'd like to touch on something you brought to our attention, Egie, and you were talking of the Debt Management Office adverts that they've been putting out. And interestingly, and I've got the advert in front of me where they're indicating the debt to GDP levels of various emerging markets and other countries as well. Nigeria debt to GDP sitting at 17.6%. And of course, the countries that are pretty much on that level, Gabon is sitting at around 18% of debt to GDP, Egypt at 85% of debt to GDP, and South Africa at 35% of debt to GDP. So in other words, Nigeria being one of the lowest indebted countries within the emerging market space. What do you make of all this news?
I think it's quite interesting. I mean, the Debt Management Office obviously has some kind of PR strategy because this is the second or third set of adverts they're putting out. And this has a bit more detail and more comparisons. There's been a lot of debate as to how much debt is acceptable. I think some of these numbers have to be put in context, the Nigerian context. So, for instance, federal government, I mean, I think the numbers are actually consolidated, state and federal government. But federal government recurrent expenditure is over 70%, and pretty much that money has very little development value. So, if you have very high recurrent expenditure, over 30% of the budget is salaries. Clearly, any borrowing to finance that budget is not really for development. So there's a certain amount of adjustment that has to be done for the amount of the debt that actually goes into physical infrastructure development in the country. Also, there's the issue of the different tiers of government. Some states try to push the GDP discussion, but in Nigeria, state governments don't charge corporate tax. Corporate tax is federal government regulated. The states make income tax only. And so some of those GDP numbers become less relevant to some states that have very little ability to raise taxes or raise revenues from taxes. Yeah. But overall, I think the DMO is right. The numbers are quite low, but they have to look at the amount of development in place and know that if you ramp those numbers up to where you have some of the peers without equivalent development, it'll be very difficult to pay back.